back to Market on Close. We have just a few minutes left in the trading day. That means it's time for the big picture. So we'll welcome in our team from Charles Schwab. Joining us today is Cooper Howard, the director and fixed income strategist at the Schwab Center for Financial Research. Cooper, thanks as always for being with us. A big morning in terms of the jobs data that we got this morning. What were some of your key takeaways?
Yeah, I'd say it was a big morning in terms of the jobs data, but it was also kind of a confirmation of a lot of what we'd seen this week overall. And that's really kind of a slowing labor market, a labor market that's been in the no hire, no fire zone. And we're still in that no hire, no fire zone. And you saw that today with the economy only adding those 22,000 jobs. That was well below where the consensus was in the 70,000 range. Also, the unemployment rate ticking up a little bit. So if I take it all together, Marley, it really just shows that the labor market continues to slow, the economy continues to slow, and this is kind of confirmation of what we expected to happen in terms of where rates are moving. We saw a big move down in short-term rates, also longer-term rates are drifting a little bit lower on growth concerns. So kind of a confirmation of what we'd been expecting looking back a little bit.
Yeah, and I was just talking to Phil Strebel about that as well as some of the rate response to the report. But Cooper, you always do such a good job looking under the hood at some of the numbers. And, what were some of your takeaways outside of the top line data and the revisions?
Yeah, the revisions were a big one, but also the fact that June was revised to a negative print. I think that was one of the big ones too. And that was the first negative print, Marley, that we've gotten going all the way back to 2020. So the era of COVID, if we remember back that far. Also under the hood, there was a lot of weakness among most all sectors. So the ones that actually only really saw gains were healthcare. And then we saw negative prints in many of the other sectors. So again, it's more just confirmation that overall the labor market continues to slow.
And as far as the Fed goes, this all but solidified the September cut. The question now is how big that cut is going to be. Yesterday, when we were discussing this for most of the day, it was 25 basis points. Overnight, just in the span of today, we've jumped this morning to about 12% of traders thinking it's going to be 50 basis points. What do you think our first cut's going to look like? And also, how has this potentially changed the rest of the year?
Yeah, so we still do expect that first rate cut's going to be 25 basis points. And then from there, depending on how the data comes in, we do expect at least another rate cut, likely in December. But if we do show further softness and further weakening in the labor market, then that could raise the potential for a third rate cut this year. Now, looking at the other side of the Fed's mandate, the inflation side of the mandate, that's going to be a concern to them because we know that tariffs are obviously one of the big question marks in terms of how that's going to affect the economy. Are they a one-time price increase, or is there going to be longer-term ripple effects? So that they do need to be cognizant of. And I'd be surprised if they go 50 basis points based off of where we are in the economy and where the data has been coming in, because they really, given that inflation is above their 2% target, they want to be cognizant of that and they don't want to cause a growth or an inflation scare into the market.
And I want to talk about that downward revision to show that first loss we've seen since the pandemic, the time none of us try to think of and we're all trying to forget. Do these latest figures, including that revision, do you think that they're going to start to raise some recessionary concerns? My last guest said, I'm surprised nobody's saying recession. And while I'm the first one to say it on this show, I certainly read it a lot today.
Yeah, I think it's very early to discuss recession. I mean, if we look at the whole picture, the unemployment rate's only at 4.3%, so that's relatively low by historical standards. Yes, it has been ticking up, but it's not falling off a cliff. And also, if we look at a lot of the other metrics, they're not screaming recessionary in today's environment. So I think it's a little early to wave the recessionary flag. But yes, the economy is slowing to a full negative print, probably not there yet.
And in this type of economy, what are some of the fixed income strategies that someone should be deploying right now?
Yeah, so one of the strategies, Marley, we've been discussing with many of our clients is to target that benchmark duration. So our view on interest rates, like I kind of mentioned a little bit before, is that short-term rates should continue to move lower as the Fed cuts interest rates. So whether they're going to cut 2 or 3 times this year, we know it's very likely that they're going to cut interest rates this year and into next year. And therefore, that should bring short-term interest rates down. So we've been suggesting move out the yield curve a little bit, not too far, but target that benchmark duration. And that way you're not subject to reinvestment risk once the Fed does start cutting interest rates. Now, in terms of the sectors that look fairly attractive right now, Marley, we do think that longer term munis can make sense if you have a little bit higher of a risk tolerance and you can stomach some of that interest rate risk, because yes, they are much more volatile than shorter term bonds.
And in terms of credit quality, how important is that right now in terms of minimizing your investment risk?
I do think that credit quality is important in this environment. The economy, yes, it is slowing, but again, it doesn't appear that it's falling off a cliff. So corporations are in relatively good shape, as well as municipalities are in pretty good shape. So that provides some buffer if things do slow more than expected. But really, why we've been suggesting staying up in credit quality is just spreads are very, very tight. So you're not getting that much compensation for taking on that additional credit risk. Given the potential headwinds coming down the pipeline and the fact that you're not getting compensated for those potential headlines that might be coming down that pipeline, we do think staying more up in credit quality, Marley, makes sense in this environment.
Well, Cooper, we appreciate it, as always, you joining us this afternoon, and hope you have a great rest of your weekend. That's Cooper Howard from the Schwab Center for Financial Research.